Let's go ahead and talk about mergers and goodwill impairment. A statutory merger occurs when one firm buys another and the acquired firm ceases to exist as a separate legal entity. The acquiring firm assimilates or absorbs or assumes all the assets and liabilities of the acquired firm. The acquiring firm records the assets and liabilities at their fair values. The original historical cost, the accumulated depreciation, the book value to the previous owner is all completely irrelevant. Now, oftentimes an acquired firm is going to have intangible assets which are unreported. For example, customer lists, in-process research and development, patents or copyrights which had a trivial book value. These assets are going to be recognized on the books of the acquiring company if they meet one of two criteria. Either they represent some legal or contractual right, or if they are separable or transferable, then they can be recorded on the books of the acquiring company. If the firm pays more than fair value of the assets and liabilities acquired, the excess is recorded as goodwill. If the firm pays less than fair value, which is going to be extremely uncommon, then the savings, the discount, is reported as a gain on acquisition or gain on bargain purchase or something to that effect. Let's go ahead and do a quick example. Let's go ahead and assume that on January 1st, one big company acquired little company for $200,000 in an acquisition to be accounted for as a merger, and little company had the following assets and liabilities at that time. And again, there's a list, essentially their balance sheet on the date of acquisition with their assets and liabilities at book value and fair value. And again, the book values are completely and utterly irrelevant. What we're concerned with are the fair values of these assets. Now let's also assume while we're at it that in addition, big company also paid $30,000 in legal and consulting fees as part of the acquisition. I guess the first thing we should do is go ahead and figure out how much goodwill or bargain purchase there is. So what do? We're going to compare the price paid versus the fair value of the net identifiable assets. The fair value of the assets is $220,000, cash plus inventory plus property, plant, and equipment. The fair value of the liabilities is $135,000, current liabilities plus bonds payable. So the net assets are $85,000. Again, $220,000 minus $135,000. We paid $200,000, which means we paid a premium of $115,000. That's going to be our goodwill in this transaction. Now let's go ahead and record the acquisition. And again, we're going to record these assets and liabilities at their fair value. Notice that the property, plant, and equipment, we're simply recording that at $150,000. The accumulated depreciation, which little company had on their books, is completely irrelevant. One thing we do note on the credit side, the bonds payable have a face value of $100,000. They're worth $105,000, which means there's a $5,000 premium on those bonds payable. So although the previous book value of the bonds is irrelevant, again, previously they were being carried at a discount, it is relevant that we separate the face value and any premium or discount when we record the acquisition. And of course, we put the goodwill in our books at $115,000. The incidental acquisition costs, the legal and consulting costs, are expensed as incurred. So merger expense, legal expense, something to that effect. Now let's go ahead and talk about contingent consideration. Basically, in many transactions, the final purchase price depends upon or is contingent upon the results of operations, in the first year or over the first two years or 3 years or 5 years. These forms of contingent consideration need to be estimated, and the present value of that estimated contingent consideration is treated as part of the acquisition cost. In the case of a contingent additional cash payment, the amount is treated as a liability. If it's a contingent issuance of additional shares, it's going to be treated as an additional source of paid-in capital. So let's go ahead and go back to our big buys little example. Let's assume that in addition to the $200,000 cash payment, Big also promises little shareholders a cash bonus of $50,000 if earnings exceed $300,000 at the end of the first year. Now we have to find some admittedly subjective estimate of what's the likelihood that's going to happen. So let's say Big estimates that there's a 20% chance that this is going to happen. That means the expected value of the payout is the amount of the payment times the probability of the payment happening, 50,000 times 0.2 or 10,000. Now again, the 10,000 is the expected value. Clearly the true value is either going to be 0 if they don't meet the earnings target, or $50,000 if they do meet the earnings target. The $10,000 is simply the statistical expected value of that future compensation. Now again, assuming a 10% discount rate, we want to record this at the present value. So the present value of $10,000 after 1 year at 10% is $9,091. So again, this $9,091 is going to get added to the cost of the purchase, thereby increasing the goodwill or decreasing the bargain purchase, as the case may be, and is recorded as a contingent liability. So here's our initial purchase. Again, basically we're adding $9,091 as an additional, not an expenditure, but as an additional cost to the purchase. And so our goodwill, instead of being $115,000, is $115,000 plus that $9,091, or $124,091. Again, if instead of a contingent cash payment, it was a contingent stock issuance with the same value, the credit would be a credit to paid-in capital rather than to a liability account.
At the end of the current period, we need to accrue interest on that contingent liability. Recall that it was recorded at the present value, $9,091. So at the end of the year, we need to accrue interest at 10%. Again, we discounted that at 10%, so we'll accrue interest at 10% and add that to our contingent liability. So now our contingent liability is up to $10,000, and at this point, one of two things will happen. Either we will miss the earnings target and pay nothing, or we'll hit the earnings target and pay $50,000. Either way, we are certainly not going to pay $10,000. If we pay more than $10,000, that additional payment will be recorded as a loss. If we pay less than $10,000, the savings will be recorded as a gain. So first, let's assume that we miss the earnings target, we have to pay nothing. So basically that $10,000 contingent liability turns out not to have been an actual liability in the end, so we get rid of the liability and we record that as a gain. If we do have to pay the $50,000, then we've got to write a check for $50,000 to pay off a $10,000 liability, so the extra $40,000 that we pay is going to be recorded as a loss. Now, if this had been a contingent share issuance obligation, say 10,000 shares with a $1 par value, we would again estimate the likelihood that the shares would be issued and the value of those shares as of the date of the business combination. So again, let's say there's a 20% chance that we're going to hit the target and the current value per share is $8. So our expectation is the expected number of shares would be 2,000 shares, the 10,000 shares to be issued times the probability that the shares would be issued, and those 2,000 shares are worth $16 a share. So that's the value we would assign to the contingent consideration. It would be added to the purchase price of the acquisition, increasing goodwill or decreasing the bargain purchase. And it would be recorded as either simply paid-in capital or additional paid-in capital or other paid-in capital, basically some variant of paid-in capital. Now, here's how we would record that business combination with a contingent issuance agreement of additional shares. Again, all of the assets and liabilities are recorded at their fair value, just as they were before. We record our $200,000 cash payment, but now in addition, we're also going to record $16,000 of additional paid-in capital being created. And again, that $16,000 gets added to the goodwill that was already created. Now, this is not a liability, this is an equity claim, so we will not accrue interest on this contingent issuance cost. Now, one of two things is going to happen at the end of the year. Either we will hit the earnings target and have to issue those 10,000 shares, or we will miss the earnings target and not have to issue those shares. If we miss the earnings target and don't have to issue the shares, basically that $16,000 is going to stay in additional paid-in capital forever. If we do issue the shares, we will treat them as having been issued for $16,000. So again, we're going to issue 10,000 shares of stock. Those 10,000 shares of stock were assigned a value of $16,000 when we entered into this transaction. So basically, we're going to go ahead and create $10,000 of common stock, again 10,000 shares at a $1 par value, and that will come out of the additional paid-in capital we recorded when we entered into this agreement. It might be a little bit more clear if we take away the $16,000 of additional paid-in capital that we initially created and then replace it with $16,000 worth of stock, $10,000 par value plus $6,000 of additional paid-in capital.